China just choked global silver supply at the worst possible moment. If you were watching the markets closely, this didn't come with fireworks or breaking headlines on every screen. And this couldn't have happened at a worse time. Silver inventories were already tight. Industrial demand was already elevated. Leverage was already layered into the trade. When China moved, it didn't create a new problem. It aggravated an existing one. This is why this matters. When supply gets restricted at the refining choke point, the effects ripple outward. Futures markets feel it. Physical markets feel it. Manufacturers feel it. Eventually, everyone does. But here's the mistake most people make. They assume this is just another geopolitical headline that will fade. They assume markets will adjust smoothly. They assume someone else will step in. That assumption is about to be tested. Now here's where it gets interesting. This move didn't happen in isolation, and it didn't happen randomly. It landed at a moment when the silver market was already under structural strain. And if you stay with me to the end, I'll show you why this decision changes the balance of power in silver in ways that won't be obvious until it's too late to react. But this is only the surface. To understand what China just did, you first need to understand how fragile the global silver system already was before this move ever happened. Why this matters now. This matters now because the silver market was already running on fumes. Before China made this move, global silver supply was stretched thin. Inventories had been declining year after year. Industrial demand wasn't slowing down. It was accelerating. Solar panels, electric vehicles, electronics, data centers. All of them consume silver, and none of them can function without it. Here's the number that should stop you. In recent years, global silver demand has exceeded supply by hundreds of millions of ounces cumulatively. That deficit didn't disappear, it was absorbed quietly by inventories. And inventories are finite. If you're watching this thinking, shortages would already be obvious if they were real, understand this. Commodity systems hide stress until they don't. They look stable right up until the moment they fail to deliver. Now here's where it gets interesting. China didn't restrict exports during a surplus. It did it during a deficit. That timing is critical. It means the buffer was already shrinking when the choke point tightened. This is why the moment matters. When demand outpaces supply and a major supplier pulls back, price becomes the only release valve. But the price doesn't adjust instantly. First, availability adjusts, then behavior changes, then the price follows. And this changes everything for participants who assume silver is just another traded asset. Silver is not only a monetary metal, it's a consumed metal. Once it's used, much of it is gone for good. Here's the mistake most people make. They assume higher prices automatically bring more supply. That logic works for oil. It does not work for silver. Nearly 3/4 of silver production comes as a byproduct of other mining. You can't simply flip a switch and produce more silver because silver prices rose. If you're watching this closely, this means supply is slow to respond and fast to break. Now here's the tension you need to sit with. If China restricts refined silver while demand continues rising elsewhere, who absorbs the shock? Manufacturers, investors, governments, all of them compete for the same shrinking pool. But this still doesn't explain how a single policy move can create global consequences. To understand that, you need to understand the mechanism that turns a supply restriction into systemic stress. And that's the part nobody's talking about. The mechanism. To understand the real impact of China's move, you need to understand one simple mechanism: bottlenecks. Think of the global silver market like a highway system. Mines are on one end, manufacturers and investors are on the other. Refining is the bridge in between. You can have all the raw material you want on one side, but if the bridge narrows, traffic backs up instantly. China controls that bridge. Here's the key point. Silver doesn't move from mine to market in a straight line. It has to be refined, processed, standardized, and cleared through a small number of hubs. China is the largest of those hubs by far. When that hub tightens rules, even slightly, flow slows everywhere else. If you're watching this and thinking this sounds like a minor logistics issue, here's the number that changes your perspective. Roughly 65 to 70% of the world's refined silver passes through Chinese facilities at some stage. That is not optional capacity, that is core infrastructure. Now here's where it gets interesting. When refined silver flow slows, futures markets don't immediately reflect it. Paper markets trade promises, not metal. Those promises assume smooth delivery. The moment delivery becomes uncertain, stress builds invisibly. This is why bottlenecks are dangerous. They don't announce themselves with price spikes. They show up as delays, premiums, and quiet competition behind the scenes. If you're watching closely, this explains why physical premiums start rising before charts explode. It explains why buyers secure supply early. And it explains why those who wait for confirmation usually pay more. Here's the mistake most people make. They look at mine production numbers and think supply is fine. They ignore the refining choke point. But in commodities, where material changes form matters as much as where it comes from. Now let me connect the dots. When China restricts refined silver exports, it doesn't just keep metal at home. It forces the rest of the world to scramble for alternative refining routes that don't exist at scale. And this changes everything, because once a bottleneck forms in a system already running deficits, pressure doesn't dissipate, it compounds. But this still doesn't tell you why this move happened now. For that, you have to look at what was already breaking beneath the surface before China ever acted. And that's the primary cause that set the stage for this decision. The primary cause. The primary cause behind China's move is domestic pressure, not external politics. China didn't wake up one morning and decide to squeeze the world. It responded to a reality forming inside its own borders. Silver demand inside China has been rising faster than supply for years, and the gap has been widening quietly. Here's the number that matters. China consumes more silver annually than it produces. That gap has to be filled either through imports or by retaining refined metal domestically. When global supply tightens, that choice becomes unavoidable. If you're watching this and assuming this is about leverage or trade wars, you're missing the core issue. This is about internal consumption colliding with limited availability. Solar manufacturing, electronics, electric vehicles, grid infrastructure. These sectors don't slow down because exports look attractive. Now here's where it gets interesting. When a country reaches a point where strategic industries depend on a material, that material stops being a commodity and starts being treated as infrastructure. Silver crossed that line inside China. This is why restrictions show up quietly. No dramatic bans, no emergency declarations, just tighter controls, fewer export approvals, and more metal staying home. Here's the mistake most people make. They assume China will reverse course if prices rise enough. But when domestic priorities are involved, price is not the deciding factor. Security is. And this changes everything for global markets that relied on China as a neutral processing hub. But domestic demand alone doesn't explain why the impact will be felt globally and unevenly. For that, you need to look at the secondary force that amplifies this move far beyond China's borders. And that's where the pressure starts accelerating. The secondary cause. The secondary cause is timing, and timing is everything. China's move didn't land in a stable market. It landed in a market already stretched by leverage, thin inventories, and rising geopolitical friction. When supply systems are resilient, they absorb shocks. When they're brittle, shocks propagate. Here's the number you need to focus on. In recent years, global above-ground silver inventories have been drawn down aggressively to cover persistent supply deficits. That drawdown reduced the system's margin for error. There is less slack than most participants realize. Now, here's where it gets interesting. At the same time, inventories were shrinking, financial exposure to silver was expanding, futures positions, ETFs, structured products, and industrial hedges all layered on top of a physical base that wasn't growing. That mismatch matters. When physical flow tightens, financial structures don't adjust instantly, they assume continuity. But when continuity breaks, adjustments are violent. Liquidity retreats, spreads widen, and participants discover they were competing for the same metal without realizing it. If you're watching this and wondering why this didn't happen earlier, understand this. Markets tolerate imbalance until a catalyst forces repricing. China's move didn't create the imbalance, it revealed it. This is why the timing is dangerous. A supply restriction during surplus creates inconvenience. A supply restriction during deficit creates conflict. Someone gets metal, someone doesn't. Here's the mistake most people make. They assume paper markets can always smooth things out, but paper claims only work when physical delivery is assumed to be available. Once that assumption weakens, confidence erodes fast, and this changes everything for silver pricing dynamics going forward. But this kind of pressure isn't new. The structure you're seeing now has appeared before, under different names and different conditions. Let me connect the dots, because history doesn't repeat perfectly, but it does leave fingerprints. The historical rhyme. This is not the first time a strategic metal has been pulled inward before the rest of the world understood what was happening. History doesn't announce turning points. It reveals them later, once the consequences are unavoidable. And when you look back at prior commodity stress events, the pattern is unmistakable. Here's the number that matters. In past cycles, when key industrial metals shifted from export-driven flow to domestic retention, global markets didn't react immediately. The reaction lagged by months, not days. Price stayed deceptively calm while availability tightened quietly in the background. Now here's where it gets interesting. Every time this has happened, the same sequence followed. First, export friction, then rising physical premiums, then delivery delays. Finally, a repricing event that most participants called unexpected, even though the signals were visible all along. If you're watching this and thinking this feels slow, understand this. Structural supply shifts move at policy speed, not market speed. By the time charts reflect reality, positioning has already changed. This is why the current moment rhymes with earlier inflection points. Not because the numbers are identical, but because the behavior is. Retention over distribution, security over pricing, control over efficiency. Here's the mistake most people make. They assume today's globalized system prevents this kind of fragmentation. It doesn't. It hides it until pressure forces alignment. And this changes everything for how silver should be viewed going forward. Not as a freely flowing commodity, but as a strategically constrained input. But history alone doesn't tell you whether this leads to escalation or stabilization. For that, you have to examine both sides of the argument clearly. Now here's where it gets serious. There is a bearish case that cannot be ignored and a bullish case that refuses to break. And the tension between those two determines what happens next. The bull versus bear case. The bearish case sounds rational, and that's why it's dangerous to dismiss it. From this perspective, China's move is temporary. Controls ease, alternative refining routes emerge, markets adapt, prices absorb the shock and move on. In this scenario, silver experiences volatility, not a structural shift. Supply reroutes, pressure fades. Here's the number bears lean on. Global mine production still exceeds 800 million ounces annually. On paper, that looks sufficient. From this view, refining bottlenecks are inconvenient, not decisive. That argument deserves to be acknowledged. But here's the mistake most people make. They treat production and availability as the same thing. They are not. Now, let me connect the dots because the bullish case doesn't rely on panic or prediction. It relies on constraint. Here's the counterweight. Silver is not stockpiled like oil, it is consumed. Once it enters industrial use, much of it is gone. Recycling is limited, substitution is weak. That makes flow more important than headline production. And this changes everything. If you're watching this closely, here's the number that matters. Industrial demand now absorbs more than half of annual silver supply, and that share is rising. Solar alone continues to add millions of ounces of demand each year. That demand does not pause because exports tighten. This is why the bullish case holds. When a consumed input faces restricted flow, pressure accumulates even if prices hesitate. And once pressure builds far enough, repricing doesn't ask for permission. But that doesn't mean risk disappears. Policy reversals are possible. Demand can slow in downturns. Substitution efforts accelerate at high prices. These are real forces. Here's what separates reset from reversal. In reversals, flow improves and pressure eases. In resets, pressure remains even when price pulls back. Which one this becomes depends on confirmation. And that brings us to the only thing that matters now. What signals tell you which path the market is choosing? And this is the part nobody's talking about. Confirmation, posture, and the decision point. Here's what confirms whether China's move becomes a temporary disruption or a lasting shift. First, watch physical availability, not price headlines. When supply stress is real, delivery times lengthen before charts react. Premiums stay firm even during pullbacks. Buyers secure material early instead of waiting for confirmation. Those behaviors matter more than candles. Second, watch inventory behavior. If inventories continue to trend lower while exports remain constrained, pressure is compounding. If inventories rebuild quickly, the system is adapting. That difference tells you whether this was a warning shot or the start of a squeeze. Third, watch how manufacturers respond. When end users begin locking in supply at higher costs instead of shopping for the lowest price, it signals fear of shortage, not confidence in abundance. If you're watching this and asking what I'm doing, understand this clearly. This is posture, not advice. I'm not chasing headlines. I'm not reacting to single-day moves. I'm watching flow, availability, and behavior. Those signals move before price does. Now here's where it gets interesting. There are 3 types of people watching this moment. The first dismisses it. You assume controls loosen, markets normalize, and nothing changes. The second is paralyzed. You see the risk, but wait for certainty that only arrives after repricing. The third recognizes inflection points when they appear quietly, not loudly. Which one you are determines whether you react late or prepare early. Let me restate the thesis clearly. China didn't just tighten exports. It exposed how dependent the global silver system had become on a single refining hub at a moment of shrinking buffers and rising demand. That combination matters. It doesn't guarantee outcomes, it changes probabilities. This moment will be remembered not because of a single announcement, but because it marked a shift from abundance assumptions to constraint reality. If this helped you see the structure beneath the headlines, share this with one person who still thinks this is noise. Drop a comment so I know you're tracking the signals. Subscribe if you want analysis that focuses on flow, not hype. Stay disciplined. Stay observant. This market rewards those who watch behavior, not those who chase confirmation. And one more thing before you go. The real tell won't be a price spike. It will be the absence of relief. When pullbacks fail to restore flow, when availability doesn't loosen, when buyers refuse to wait, that's when you'll know this wasn't temporary. Watch that closely. It decides what comes next.